Hello, in today's video, we're going to address a very commonly asked question that we receive from clients. And this one's coming from Frank and Sarah. Again, the names have been changed. The situation has been modified to maintain privacy, but this covers a very common example that we get from clients. So Frank and Sarah are both retired. Sarah, as a child, remembers fondly times where her extended family would get together for some really fun summer getaways. And so, now that they're in retirement for a few years, they're wondering, well, can they do the same thing with their family? And as they know, having their grown children in the midst of raising little kids, it might be expensive and, kind of cost prohibitive to bring families together. So they're wondering to know, hey, can we go ahead and pick up the expense? Can we buy the big Airbnb or buy the cabin, rent it out for 10 days and help cover some of those expenses so that family members don't have to worry about the burden of cost, but can all gather together and to share in some of those experiences. So we're going to go ahead and spend a few moments here walking through their financial scenario and showing under the hood a little bit of the financial planning tools that we as a firm use to help clients answer these very similar questions. My name is Doug Omont. I am the Chief Planning Officer here at Bander Wealth Management, and look forward to spending a few moments here going through how we address this type of question for clients similar to Frank and Sarah. All right, so we can see, again, both retired, Frank age 65, Sarah age 66, and we'll take a look at their current investment portfolio. Frank has a traditional IRA of approximately 925,000. Frank also has a Roth IRA of 95,000. Sarah has a traditional IRA value of 105,000, and then jointly they have a brokerage account of 350,000. So all in current investment portfolio right around 1.475 million. In terms of other income sources, they both receive Social Security. So at full retirement age 66, Frank will receive $3,100 per month. And Sarah, at her full retirement age 66, she'll receive $2,850 per month. So let's take a look now at a tool that we use called Income Lab. And this is where we'll illustrate to clients a couple things. One, what's their current spending capacity? So based on your current investments, plus taking into account all of your various income sources, where in this case for Frank and Sarah, we're looking at Social Security, how much can you afford to spend per month without running the risk of overspending your account? That's probably the most common risk that we hear in retirement is the fear of running out of money. And then another fear, and really often overlooked, however, is underspending. And so, dying with $1 million in the bank is not a goal. So we try to keep you on the path of staying within your guardrails, as we call it, making sure you don't overspend, but at the same time, making sure you don't live a life of regret and say no to things that you honestly could have afforded to do much earlier in life. So we'll take a look at this now. So again, this is the current balance of 1.475 million. Again, that's broken up between the joint brokerage account, Frank's Roth IRA, as well as his IRA and Sarah's traditional IRA. For the scenario, we're just going to do a very conservative, balanced portfolio of 60% stocks, 40% bonds. We're showing based upon their current assets, they have a spending capacity of just over $12,200 per month. Okay, so now let's take a look at what impact would it have if we go ahead and plan this big summer vacation next year. So we'll go into expenses. This is a one-time expense. So we're going to call this, an epic family outing for Frank and Sarah. We're just going to code it for travel. And they were projecting that the cost of getting together for 7 to 10 days would be roughly $40,000. So we'll go ahead and put that amount in. It's a one-time cost. And we're currently projecting that we'll do this, sometime during the summer next year. So we can go ahead and update the plan and see what impact that's going to have on their current spending capacity. And we can see. So if you recall, prior to adding this expense, their spending capacity was roughly $12,200 per month. And that's dropped by about $150. So just over $12,000 per month. Knowing that in this case, Frank and Sarah only needed $10,000 per month to really live a very fruitful life. They already have a cash cushion. Having that family experience is not going to impact their plan. And so that's one way we go ahead and we'll look at this with clients. Another way is, so you can see down here, so this blue dotted line, this reflects their current investments, 1.475 million current spending. This, of course, includes that family vacation next year, so $12,000 per month. The lower guardrail, this is that guardrail that we put in place to make sure that you don't overspend your account. Again, running out of money is not an option. So we want to make sure we keep you safely on that road. This shows that, the portfolio would have to drop in value by over 22%. Over $328,000 before we saw a pretty modest, $603 reduction in spending. So another way that we'll address this type of question is, instead of planning for a specific dollar amount, just knowing, hey, you can overspend your monthly spending allowance at any time. What happens is it just brings this lower guardrail into play potentially sooner. It doesn't need to rise necessarily a state of fear or concern. It just means that, hey, there might be an adjustment or a course correction that we need to take at some point down the road. And so one of the things that we try to stress most at our firm is that we don't do financial plans, we do financial planning, meaning it's an ongoing, ever evolving, changing process, because we know life happens, plans change, things change. And so we're constantly monitoring your plan, making sure that you're staying within your guardrails, and then giving you that permission to spend, to enjoy life now. We talk about there's 3 stages of retirement: the go-go years, the slow-go years, and the no-go years. So that first period of retirement, those go-go years, where you have the energy, you have the vitality, desire, and will to go ahead and create these experiences, we want to encourage you, give you that permission to do so. Because one of the things we know when we talk with clients who are a little bit further on down that retirement arc and they're in the slow go or no go years, is they recall fondly the times when they went on those family vacations, they created those experiences. And one of those things that they do is they create these things called memory dividends. And so 15, 20 years, you can still be looking through a photo book, a scrapbook, and reliving some of those family outings that you had. And so in this case, we're going to ahead and encourage Frank and Sarah to go ahead, bring the family together, have those experiences, and really maximize life and create those memories. And so hopefully this was insightful. We'll continue to do more of these short videos to give you a little bit more insights into some commonly asked questions that we receive from clients, and to show you behind the scenes on some of the financial planning tools that we utilize as a firm, helping address and give that peace of mind and clarity to clients.